what's going on with fixed income and the bond market and cash, and what is the FDIC? What are all these things? So first I'll start by saying that the Silicon Valley Bank, there was a run on the bank, which if you remember in Mary Poppins, what happened to the dad of Mary Poppins, there was a run on his bank. Everybody wanted the money all at once. It actually softened him up a little bit and he was able to dance with Mary Poppins at the end. But in this case, there was a run on the bank where everyone wanted their money all at once. And this caused a problem for the bank. The FDIC, the Federal Deposit Insurance Corporation, went in and they insure your deposits up to $250,000 per person or $500,000 for a joint account. And everyone should have their insured money by Monday. So that's great. They came in on a Friday afternoon before the close of business and they're taking care of things, which is good to know, right? To make sure that your money is FDIC insured, at least at the bank, right? This doesn't work for brokerage accounts, but it works for bank accounts. So inflation is the diagnosis. We have high inflation right now. We all know this. We can see it in the grocery store and at the gas pump, everywhere, right? Our home energy prices as well. So inflation is the diagnosis, and the cure is what the Federal Reserve can do, which is to raise or lower interest rates. So they've chosen to raise interest rates or raise the cost of borrowing money to cool the economy down a little bit and to alleviate inflation. Is it working? A little bit, a very little bit. It's not getting worse. So that's what's going on there. So, but this has other effects. And one of the effects is, like, if I loan money to you and you issue me a bond, which is a promise to pay. If I loan money to you in, let's say, 2019, bonds were yielding about 0 to 1% interest. That was as good as we could get back then. However, now you can have a 1-year treasury bond at 5%. So if I'm holding a bond, a promise to pay from someone, and it's yielding 1%, if I go to the marketplace and try to trade that bond, I might be able to sell it, but they'll buy it at a discount. Because why would you want a 1% bond when you get 5% bond? There's better bonds out there. So they're not going to give me full price for that bond. They're going to offer me a discount for that. So usually, if you hold bonds to maturity, because you can get a 1-year bond, 5-year bond, 10-year bond. If you wait all the way to maturity, you're going to get your money back. You're going to get the stated interest plus your principal back. So I'll get that 1% all the way, and I'll get my principal back, whatever I put in. Great. That's not a problem. What becomes a problem is these banks are holding bonds, and they have a choice whether to make them mark for market, which means that they're going to sell them, or they have them marked as hold to maturity, and they have to decide when they buy the bonds which one it is. So if you have your bonds marked hold to maturity, that's great. You're going to get all your money back, your principal plus the stated interest. But that becomes a problem when a 10-year bond at 1% or less, I gotta hold this thing for 10 years when there's all these great bonds going on. So banks didn't really like that, and so they changed the way they wrote their bonds to say that they would be marked for market. Great, no problem. Again, now you have the flexibility to sell those bonds. But remember what I said: if you try to sell a bond with a lower interest rate in today's market, it's going to be a loss. So what Silicon Valley Bank did is they said, hey, look, we're going to sell these bonds. We're going to get these old low interest rate bonds off our balance sheets. We're going to take the loss. We're just going to go ahead and take the loss, and we're going to buy better bonds. But what that did, that big loss, some of these tech companies got spooked. They said, nope, we don't like what their balance sheet is doing. We don't like what's going on. Let's get our cash out now. So they did that. So people did a run on the bank at the same time as they had all these losses. The bank became illiquid and they shut it down.